Hello and welcome to Chapter 7. You are well on your way to being done with this class, so congratulations, you've made it this far. Everyone's work is looking great. Thank you so much for working hard, and I'm trying to keep up on the grading and get things back to you, and I'm being mostly successful. Um, so let's talk about Chapter 7. Here we're going to talk about learning how to reconcile a credit card. So it goes very similar to where we are before. We would go to banking and then we go down here to reconcile. This box will pop up. And then instead of selecting checking, you'll go to Visa. And you'll notice right here we have service charge and interest earned, and then if we switch to a Visa, it just goes to finance charges. Credit cards don't earn interest, and so therefore we don't have any interest earned. And if you look here, mine's empty. Mine's already been reconciled. But I want to show you, I'm going to go back out of this screen. I'm going to go back to banking, back to reconcile, here to Visa, and I can undo last reconciliation. And this box is going to pop up and it says, are you sure you want to undo previous reconciliation? And then you hit continue, and you're going to hit yes, I understand, and then you can go in here and you can tell it you want it to reconcile again. And my guess is it's going to say, yep, there's still nothing there. But when you get here, you're going to have charges and your payments. You're going to check them off just like you did on previous chapters and just like reconciling the bank. So let's spend a few minutes talking about why is it important to reconcile your credit cards. You want to make sure that everything that you charge to your credit card is ended up in QuickBooks. I see this time and time and time again where business owners don't have everything off their credit cards in QuickBooks. That can be a huge problem. We want to make sure that everything that is being charged to that credit card, even if it's personal, is going to be included in QuickBooks. So that is very, very important. Okay, and the other thing, this chapter, we start talking about partnerships. So partnerships, their profit and loss, their income statement looks identical to a sole proprietor. The change is down here in the equity section of the balance sheet. Right here in this equity section, right here in the equity section, if you'll notice, you would have your name, investment, and then we have another partner right here, and then we have some stuff in other. There probably shouldn't be anything in other when we get done. The other thing I want to bring to your attention is when you are splitting up your net income or any of those types of things, be sure to use your balance sheet. Do not go up to your chart of accounts and use that balance on there. It will lead you astray every single time. Pull up your balance sheet, make sure your date is correct, and those are two very, very, very important things as part of this chapter, because you're splitting out net income between the partners instead of just moving it from retained earnings into their capital account as you did in the sole proprietor. So not much different than what you've done before, but definitely keep track of that. So the other thing that this chapter talks about, let me get rid of that. The other thing this chapter talks about is making general journal entries. And although QuickBooks does a lot of things automatically, this chapter wants to make sure that you have a good idea of those debits and those credits and what's kind of happening in the background. So the chapter does a really great job of kind of walking you through that step by step. One of the other things I want to show you and talk about is some of the reports. So I'm going to pull up my profit and loss, and I'm going to change the date to all so that, oh, we don't have anything. Just a second, I'm going to pause the movie and bring up a different file. Okay, so I've got another file open and I just pulled up a profit and loss. But what I want to point out here is that right here, right over here, I have that it's accrual-based accounting. Right here. Meaning that we book income when we earn it, not when we receive it, when we earn it, and we book expenses when they are incurred, not when they're paid. And you select whether it's a cash basis or an accrual basis company when you do the setup, and you'll learn about that in about 2 more chapters. But what I want to point out is that you can go here to customize report and you can change this to cash. And this is going to become all zeros. Why is it going to become all zeros? Well, because they've done the work and they haven't collected one darn thing. Nothing has gone into their bank account. The great way to think of cash basis tax or cash basis accounting is what goes in your bank account. And I can switch this back to accrual and it'll show up. So that's one of the great things about QuickBooks is you can switch between those two items just in the blink of an eye. Okay, so I'm going to go back over to this partnership. So one of the things you're going to learn down here in the balance sheet is each one of these, each partner is going to have a draw account, and you're going to learn how to close out those draws, how to put draws into there. So be paying attention when you get to that point. That is about it for this chapter. Good luck, and if you have any questions, please feel free to email me.